Easy Money, Risky Business, the Yen-Dollar Carry Trade, written by Michael Lewis. Imagine a game where the rules seem simple, but the stakes are incredibly high. Borrow money cheaply in Japan, where interest rates have been historically low for decades. The Bank of Japan has kept these rates near zero to stimulate the economy. Then take that borrowed money and invest it in higher-yielding assets in the United States. These assets could range from stocks and bonds to real estate and other financial instruments. The goal is to profit from the difference in interest rates between the two countries. This, in essence, is the yen-dollar carry trade. It's a strategy that has been employed by investors and financial institutions for years, capitalizing on the disparity between Japanese and American interest rates. It's a strategy that has attracted investors for years, promising easy returns in a world of low interest rates. The allure of seemingly easy money has drawn in everyone from individual traders to large hedge funds, but like all things in finance, there's a catch. The carry trade is not without its risks. Currency fluctuations, changes in interest rates, and geopolitical events can all impact the profitability of these trades. And sometimes that catch can trigger a market crash. When too many investors unwind their positions at the same time, it can lead to a rapid appreciation of the yen and a corresponding crash in asset prices. This isn't just about currencies. The yen-dollar carry trade is a microcosm of the broader financial system, illustrating how interconnected and interdependent global markets have become. It's about understanding how interconnected the global financial system has become. A decision made by the Bank of Japan can ripple through financial markets around the world, affecting everything from stock prices to commodity markets. A tremor in Tokyo can be felt on Wall Street in the blink of an eye. The speed at which information and capital move in today's world means that local events can have global consequences almost instantaneously. And when those tremors become earthquakes, the consequences can be devastating. Financial crises can spread quickly, leading to widespread economic turmoil and significant losses for investors. Welcome to the world of high-stakes finance, where fortunes are made and lost on a daily basis. In this arena, knowledge, timing, and a bit of luck can make all the difference. The yen-dollar carry trade is just one example of the complex strategies that drive global financial markets. Borrowing low, investing high, the mechanics of carry trade. The mechanics are simple, but to truly understand the intricacies, we need to delve deeper into the process and the risks involved. Investors borrow Japanese yen at ultra-low interest rates. Japan has maintained low interest rates for years, making it an attractive source of cheap capital. They then convert this borrowed yen into US dollars. This conversion is crucial because the US market offers more lucrative investment opportunities compared to Japan. These dollars are then used to purchase US assets, such as stocks or bonds, which offer higher returns. The US financial market is known for its robust performance and diverse investment options. The difference between the low borrowing cost and the higher investment return is the profit. This profit margin can be substantial, especially in a stable economic environment. It's like borrowing money for next to nothing and lending it out at a much higher rate. This arbitrage opportunity is what makes carry trade so appealing to investors. This strategy works as long as the exchange rate between the yen and the dollar remains stable. Stability in exchange rates ensures that the conversion costs do not eat into the profits, but currencies are notoriously volatile. Exchange rates can fluctuate due to various factors, such as economic policies, geopolitical events, and market sentiment. When the yen strengthens against the dollar, the profits from the carry trade start to erode. A stronger yen means that more dollars are needed to repay the borrowed yen, reducing the profit margin, and if the yen appreciates significantly, those profits can quickly turn into losses. In extreme cases, investors may face substantial financial losses, making carry trade a high-risk strategy. Central banks play a crucial role in this dynamic. Their decisions on interest rates can have a profound impact on the carry trade. For instance, if the Bank of Japan decides to raise interest rates, the cost of borrowing yen would increase, making the carry trade less attractive. Economic indicators such as inflation rates, GDP growth, and employment figures also influence the carry trade. Investors closely monitor these indicators to gauge the economic health of the countries involved. Geopolitical events can also cause significant fluctuations in exchange rates. Trade agreements, international conflicts, and political instability can all impact the value of currencies, adding another layer of risk to the carry trade. Given these risks, investors often employ various risk management strategies. Hedging, diversification, and stop-loss orders are some of the techniques used to mitigate potential losses. Despite the risks, carry trade can be a profitable strategy if executed correctly. Historical data shows that during periods of economic stability, carry trade has yielded significant returns for investors. Education and awareness are key. Investors need to stay informed about market trends, economic indicators, and geopolitical events to make well-informed decisions. Financial education seminars and investment workshops can provide valuable insights and strategies. Modern technology has made it easier for investors to engage in carry trade. Digital trading platforms provide real-time market data and analytical tools, enabling investors to make quick and informed decisions. In today's interconnected global economy, the carry trade is a testament to the complexities and opportunities of international finance. It highlights how investors can leverage differences in economic conditions across countries to generate profits. Ultimately, the success of carry trade depends on a combination of factors including economic stability, exchange rate movements, and effective risk management. When done right, it can be a powerful tool for financial growth. As the trading day comes to an end, investors review their performance and strategize for the future. The carry trade remains a popular strategy, but it requires careful planning and constant vigilance. In conclusion, while the mechanics of carry trade are straightforward, the execution requires a deep understanding of financial markets and a keen eye on global economic trends. With the right approach, it can be a rewarding venture. Riding the wave carry trade and the Nikkei's ascent. For years, the yen-dollar carry trade fueled a surge in the Japanese stock market, the Nikkei. This financial strategy, where investors borrow in a currency with low interest rates like the yen and invest in assets with higher returns, has had a profound impact on Japan's financial landscape. Investors, flush with cheap yen, poured money into Japanese stocks, driving up prices. The allure of easy profits attracted a diverse group of market participants, from individual traders to large institutional investors, all seeking to capitalize on the favorable exchange rates and the booming stock market. The Nikkei became a proxy for the carry trade, rising and falling on the whims of currency speculators. This close relationship meant that any fluctuations in the yen-dollar exchange rate could have immediate and significant effects on the stock market, creating a highly volatile environment. This created a dangerous feedback loop. As the Nikkei climbed higher, it attracted even more carry trade investors, further inflating the bubble. The rising stock prices seemed to validate the strategy, encouraging even more borrowing and investment, which in turn pushed prices even higher. As the Nikkei climbed higher, it attracted even more carry trade investors, further inflating the bubble. The market's upward momentum appeared unstoppable, drawing in more and more capital from around the world. This influx of foreign investment created a sense of euphoria among traders and investors who believed that the good times would never end. But this dependence on foreign capital made the Japanese market incredibly vulnerable. The reliance on external funding meant that any shift in global financial conditions could have a dramatic impact on the Nikkei. Factors such as changes in interest rates, geopolitical tensions, or economic downturns in other parts of the world could all trigger a sudden reversal of fortunes. Any change in sentiment, any hint of risk aversion could trigger a mass exodus of capital, sending the Nikkei tumbling. The very forces that had driven the market to new heights could just as easily lead to its downfall. Investors, once eager to take advantage of the carry trade, could quickly become risk-averse, pulling their money out of Japanese stocks and causing a sharp decline in the market. This precarious situation highlights the inherent risks of relying too heavily on foreign capital and the volatile nature of the carry trade. Shifting sands, exchange rates, and the fragility of profits. The Achilles heel of the carry trade is the constant fluctuation of exchange rates. When the yen strengthens against the dollar, as it did in the days leading up to Monday's crash, the profits from the carry trade begin to evaporate. Suddenly, those seemingly safe bets become risky propositions. Investors, fearing further losses, rush to unwind their positions, selling their Japanese assets and converting their yen back into dollars. This mass selling pressure creates a downward spiral, pushing the yen even higher and further, depressing the value of Japanese stocks. The house of cards begins to collapse. The interest rate tightrope. When cheap money backfires, central banks play a crucial role in the carry trade equation. Their decisions on interest rates can make or break the profitability of this strategy. When the Bank of Japan keeps interest rates low, it encourages investors to borrow yen and seek higher returns elsewhere. But what happens when the Bank of Japan hints at raising interest rates? Suddenly, the cost of borrowing yen becomes less attractive. The carry trade becomes less profitable and investors start to re-evaluate their positions. This uncertainty can trigger a sell-off as investors rush to lock in their profits before the music stops. Whispers of doubt, insider selling before the storm. In the days leading up to Monday's crash, there were whispers of trouble in paradise. Market insiders, those with their fingers on the pulse of the financial world, began selling off their Japanese stock holdings. They saw the writing on the wall. The carry trade was unwinding. These insiders, privy to information not yet available to the public, recognized the fragility of the market. They knew that the Nikkei's rise was built on a foundation of cheap money and speculative fervor, and they knew that this party couldn't last forever.